in the next 15 minutes, you will see what all accounts we have to prepare in a partnership business to know whether the business is making money or losing money. If you just take a look at kirana stores or small grocery shops near your houses, you will find that they have a book in which they write up and add all their incomes and subtract their expenses from it to know the profit or loss of their shop. It's all about addition and subtraction. Literally, anyone could do this. You need not study accountancy to add and subtract. But when it comes to a partnership business or a company which is supposed to follow the government rules and regulations, this addition and subtraction is not allowed. This is something which is more serious, and as per the government rules, we have to prepare certain accounts which kind of looks like this. Well, these might look difficult and complicated, but they are actually not. Let me explain. Probably, if you have listened to your accountancy classes in 11th, then chances are you would have seen this somewhere. And this is called journal, the first place where you write any transaction that happens inside a business. For example, if a business has bought a printer, then it will be written as printer account debtor to cash account, because they bought the printer with the cash. Just like that, say if they bought a piece of land, then it will be written as land account debtor to cash account, because they bought the land with the cash. But the problem is, there will be a lot of transactions like this in a business, ranging from salary to electricity bill to postage charges to telephone bill and much more. So there will be a lot of journal entries, which created a lot of confusion, and it's not something which a common man can easily understand. So we needed much better clarity and understanding. And to solve this problem, we transferred these same journal entries to these really good-looking ledger accounts. They were more clear and much easier to understand. Take a look into this cash account ledger. Let's assume you already had a cash balance of 2 lakhs with you, and if you see the right side, you bought a printer worth 10,000 rupees and a piece of land worth 1 lakh rupees. So after spending 10,000 and 1 lakh, from the 2 lakhs, the business has a remaining balance of 90,000 rupees. See, it was much easier to understand. But there is again a problem. There were a lot of ledger accounts for a single business. The way the business prepared cash account, they would have to prepare printer account, land account, and many more like that. And chances are, sometimes there might be errors in balance calculation. Instead of 90,000, if the accountant writes it as 9 lakhs, then it might become a problem. So to check whether the balances written in these ledgers were correct, we prepared an account called trial balance, which pretty much looked like this. And it had all the balances from ledger accounts. If both left and right side total of the trial balance was equal, it meant that there were absolutely no errors. And it's a really good thing. It kind of sounds like sending wheat through a machine till it gets refined into wheat flour. We are refining our numbers again and again till we get the final answer that whether the business is making profits or losing money. And still now, we haven't got the answer. So let's move forward. Once the trial balance is over and we got the confirmation to go ahead without any errors, we have to prepare 2 accounts to get the final profit or loss information. One is called trading account, which looks like this, where we had opening stock, purchases, and some expenses like wages on the left side and incomes like sales and closing stock on the right side. And when we deducted the expenses from the incomes of the business, sometimes we got profit while sometimes we ended up with a loss. And in accountancy, they call it gross profit or gross loss depending upon the situation. But this was not the end. We still had many expenses which we are not supposed to write in trading account because accountancy rules does not allow that. So this particular category of expenses was written in a new account called profit and loss account, which looked just like this. And in order to do that, we transferred the gross profit from trading account to profit and loss account. And after that, we deducted certain special expenses like electricity charges, employee salaries from that profit. Finally, when we deducted these expenses from gross profit, we got a final profit. Well, sometimes a final loss. And in accountancy, this final amount is called net profit or net loss, depending upon the situation. And this net profit was eventually added to the capital of the business so that the business develops. All this was done in the balance sheet, which kind of looked like this, having all the assets of the business on the right side and all the loans and liabilities on the left side. That was it. And we stopped with this in our 11th standard. If you remember something, we were actually preparing accounts for a sole proprietorship business in our 11th standard, which means there was only one single owner for the business. But now, since it's a partnership business, we have more than 2 owners, and the problem is we are supposed to divide the net profit between all the partners. So instead of stopping with the net profit which we got from the profit and loss account, we are required to prepare 2 more accounts before preparing balance sheet. Let's see what they are. One is called profit and loss appropriation account, which pretty much looks like this. And let me tell you why it is prepared. It is in this account you share the net profit among the partners. And the next one that you have to prepare is called partners capital account, which looks like this. The reason for preparing this account is to know whether each partner is making money or losing money, so that he can take a decision as to whether leave the business or stay in the business. Well, let's talk more about both these accounts later on, but speaking from the exam perspective, profit and loss account, profit and loss appropriation account, and partners capital account, these are the 3 most important accounts which will be asked from this fundamentals of a partnership chapter. If we are thorough with these 3 accounts, we can score really good marks in this first chapter of partnership accounts. But before being thorough with these 3 accounts and getting into sums, you need to understand what is the difference between a charge against profit and an appropriation of profit. So, a particular expense might come under any one of these 2 categories. Either that expense will be a charge or it will be an appropriation. Let's take an example. You borrow 100 rupees from your friend and another 100 rupees from a stranger, and you're promising to return this money back within 10 days. And after 10 days, when both of them comes to you asking their money back, you give them an excuse that you don't have money. Probably your best friend would be okay with it and might ask you to pay whenever it's possible. But the response from the stranger might not be the same.
Lesnar with a nearly helpless Michaels on his shoulder.
He needs his money no matter what happens. Well, here the money that you have to pay your friend is an appropriation, and the money that you have to pay the stranger is a charge. Which means a charge is an expense which has to be paid compulsorily, whether the business is in profit or loss. No excuses. Whereas an appropriation is an expense which has to be paid only if the business has profits. You need not pay this expense if the business is in loss. Now let's see some examples of charge items.
Hot pepper.
In this Fundamentals of a Partnership chapter, there are only 3 compulsory charge expenses that you will see in most of the questions. Number 1, interest on partner's loan. Number 2, manager's commission. And finally, number 3, rent payable to a partner. Let's see what are these 3 items and why do we call them as a charge. To start with interest on partner's loan, if a partner gives loan to the firm, then he should be treated like a stranger because he compulsorily wants his money back, even if the business is in loss. So the interest to be paid to him is also compulsory, and that is why interest on partner's loan is a charge. If you are in profit, then you have to pay. if you are in loss, then also you have to pay. The next charge being manager's commission. Obviously, any business will have a manager to look after what's going on, and he should be paid any kind of salary or commission for the work that he does. So he doesn't care if the business is in profit or loss. He is doing the work and he needs his money. That is why manager's commission is a charge. If you are in profit, then you have to pay. If you are in loss, then also you have to pay somehow. The third and final charge being rent payable to a partner. Any business will need a building to set up their office or factory, and sometimes a partner might have his own building and he might suggest other partners to use his building for the business purposes and pay him a rent in return. At this point, he is just like a stranger. Probably if you are staying in a rented house, you will know the fact that you have to pay your rent even if you are not making money, else you will be thrown out. And the owner doesn't care if the business is in profit or loss. He has given his building and he needs his rent. That's exactly why rent payable to a partner is a charge. If you are in profit, then you have to pay. But if you are in loss, then also you have to pay. And all these three charge expenses, interest on partner's loan, manager's commission, and rent payable to a partner, should be written only in profit and loss account. But why? Because it's a rule. There is no proper reason as such. Profit and loss account is a place where you should record expenses that has to be compulsorily paid. Let me repeat that again. Interest on partner's loan, manager's commission, and rent payable to a partner should be recorded only in profit and loss account and nowhere else. And apart from these three charge expenses, interest on partners' capital, salary to partners, commission to partners, and transfer to general reserve, all these are appropriations of profit. But what are these things? Let's see them one by one. When a partner invests money as a capital in the business, he is ready to lose that money and it is not compulsory to pay him back. So interest on capital is also not compulsory, and that's why it is called an appropriation. If you are in profits, you have to pay, and in case if you are in loss, then you need not pay. Simple as that. But be careful, because sometimes in question they will mention interest on capital as a charge, because different businesses have different policies. Some businesses might treat interest on capital as an appropriation, while some other businesses might treat interest on capital as a charge. Next, talking about partner salary, they will be paid salary for working in the business only if there is a profit, and that is why it is an appropriation. The same concept applies for paying commission to partners. You do these things only if there is a profit. Next, talking about transfer to general reserve. This is just like a piggy bank where you save money from the profits of the business so that it can be used in case of certain emergency purposes in the future. And all these appropriation expenses, interest on capital, salary, commission, and transfer to general reserve should be recorded only in profit and loss appropriation account. But why? Again, it's a rule. There is no proper reason as such. Profit and loss appropriation account is a place where you are supposed to record expenses which are not compulsory. Let me repeat that again. Interest on capital, salary, commission, and transfer to general reserve should be recorded only in profit and loss appropriation account and nowhere else. But keep one thing in mind. In case any of these items are mentioned as a charge in the question, like interest on capital is a charge or salary is a charge, then obviously you must record it in profit and loss account. So that's all for the day. There are additional questions in the description along with the answers. Please do check it out. In the next episode, let's just have a small practice on where to record these items, either in profit and loss account or profit and loss appropriation account, depending upon the situation.